Hello, and welcome to the latest instalment in Investment Week's 2025 Outlook series. In this discussion, we will be examining some of the key themes and events during the last year in the investment trust landscape. From high levels of corporate activity, continued discounts, and share buybacks, it has been a turbulent 12 months for the industry. I'm your host, Linus Uhlig, reporter at Investment Week, and today I have the pleasure of being joined with three individuals who have had their ear to the ground when it comes to investment trusts. With me today are Annabel Brodie-Smith, Communications Director at the Association of Investment Companies, Shavar Halberstadt, Equity Research Analyst at Winterflood Securities, and Charles Cade, Board Member and Director at the Temple Bar Investment Trust and Vietnam Enterprise. I would just like to get each of your thoughts before we start kind of diving into some more topics about, as we approach the next year, what the kind of state of the investment trust sector has been in 2024. So Annabel, why don't you kick us off?
Well, it's clearly been a challenging year. As you've mentioned, we've had a lot of mergers, a lot of acquisitions. We've had some companies winding up. But performance has been strong. Year to date, the average trust is up 13% this year, and we've seen some outstanding performance from certain sectors, such as growth capital or private equity, and actually even the global sectors performed really strongly this year. So we've seen some good performance, but it's been challenging. I think the thing is that boards are listening to and engaging with their shareholders, and they are delivering what they want. Now, they might want larger, more liquid, more cost-effective companies, or they might want the ultimate decision, actually, and that company not to be in existence any longer. And I think that is really positive. We are delivering what shareholders want. And I actually think I feel very positive going forward, because I think there are lots of opportunities to make money for our shareholders next year.
So Shavar, would you concur with that?
Yeah, absolutely. I think what Annabel highlighted there is sort of a trend of strong performance that is not necessarily always being reflected in share prices, because shareholders might have different views on what the future of the trust should be. For example, this drive towards sort of larger, more liquid trust. And I think that's very encouraging, because I think we're on a trajectory to enter 2025 and beyond in a sort of much stronger, more effective sector, which will be more attractive to the outside because of lower cost, because of sort of larger size, which is an obstacle for many investors to get in, and because eventually money gravitates towards higher quality managers, right? Because the most successful, highest quality investment trusts are acting as consolidators in many cases, whereas poorer investment trusts might just exit the sector overall. So I think the end result is a stronger and healthier sector.
Mm-hmm. And Charles, I mean, obviously we've seen sort of a lot of corporate activity. We've seen a huge merger between Alliance and Witten this year. I mean, from your perspective, is this what needs to happen for the future of investment trusts? Are we going to see these kind of big investment trusts merge a bit more? I mean, how do you see that going forward?
Well, I think it depends on the nature of the fund. I think for certain funds, size is crucial, and there's certainly a lot of investors who want larger, more liquid funds. Historically, we used to talk about 100 million being sufficient. Now you're talking typically 500 million. And for Alliance Witten, where it's a mandate to be a multi-manager, having scale to give you lower fees and better access to funds certainly made sense. But I think for many funds, so if you're investing in smaller companies or frontier markets, you don't necessarily want to be huge. You want to have the right discount control measure and the right structure, but to be able to take a long-term view. So I think the key is to be the right scale and the right structure for the mandate and justify being closed end. Not necessarily just merge so that you're large.
Sure.
Can I jump on in there? I totally agree with you, Charles. Quite honestly, small can be beautiful when it comes to the size of investment trusts. And if you're investing in a specialist mandate like microcaps, of course you don't want to be too big. But clearly there has been a trend. We've seen wealth managers consolidation, and there's been a trend for larger, more liquid, more cost-effective companies, and hopefully better performing too.
Sure. I mean, let's kind of talk about, I know it's not necessarily always sort of linked to performance, but discounts is, something that has continued to dominate this year. And obviously, in terms of a kind of the price to value that you're getting, it can be quite attractive to buy investment trusts for that reason. But is it a problem that we're seeing these continued discounts? I mean, how do you see that going in 2025?
Maybe I could come in on that.
Sure.
I'm also an investor in the sector, both personally but also for a charity. So I'm buying and exploiting these discounts, which I see as a real opportunity. But I think it varies. If you look at equity funds, they're trading on a discount from maybe average of 11, but with big variation. But the real issue with discounts is in the alternatives. And there, you have to be careful on whether the NAV really does reflect the value that you could receive. So, a lot of them are trading on 20, 30% discounts. And I think you really need to understand, what's going to be the driver for that. And do you have the right corporate governance structures? But my view is there's a huge amount of value in the sector, and the time to buy it is when the sector's out of favour. But I would just caution that some of the alternative income funds that were launched in recent years, their mandate maybe is no longer valid, and they need to look at ways to restructure and return capital.
Which may still be a good buying opportunity, absolutely, because either performance is going to pick up or there will be some sort of corporate activity, and shareholders will benefit again. I mean, the thing about discounts, you have to remember, they reflect supply and demand. They completely reflect that. And if you think about the amount of outflows we've seen from open-ended funds this year, it's just seen a change now in November, but it's been a very much an outflow story. That's why we're not seeing that demand for investment trusts. Now, I have to say, I hope next year will be different. I think we've got the budget out of the way. We've got all these elections out of the way.
Yeah.
We're coming to a conclusion on the cost disclosure problems. So I think there is quite a lot to look forward to. And when discounts move, they move very quickly. I mean, you just need to look at the Trump trade, looking at companies like JP Morgan, US smaller companies, or Bailey Gifford, US growth. They were on double-digit discounts. They're very close to par right now.
Shavar, anything to add there? Or?
Yeah, no, I think that's exactly right. I think people often lose sight of the fact that it's a demand-based story, largely, these discounts. In some cases, yes, there can be a question whether certain private valuations that may have been based in a different monetary policy regime are still accurate, but that does not necessarily imply that a 40, 50 or 60% discount is warranted, which we have seen in certain cases in maybe the venture and private equity sphere. And so, generally speaking, yes, we believe the sector as a whole is an opportunity. But that is not just us saying this from a research perspective. This is echoed by the boards in the sector as well, which are conducting record buybacks, which is estimated to reach 7 billion already year to date. And that's versus 3.5 billion last year over the same period. So the sector itself has the ability to buy back shares, and it's sort of expressing this vote of confidence in the fact that these discounts are overdone. And indeed, if there are sort of triggers for demand to come back, whether that be from an interest rate perspective or whether that be from a cost disclosure perspective or otherwise, we definitely see room for improvement.
Sure. And the investment trust space has seen a lot of sagas this year. Whether that's kind of home REITs taking a while to put out its results, Hypnosis Song, whether that's DG9, and the kind of, as you mentioned, the cost disclosure campaign as well. I mean, how do you think this impacts the view of the sector? When there's so much coverage?
Well, it's clearly not helpful. Any poor publicity is not helpful for the sector. And there have been a number of instances, as you've demonstrated. But, generally, independent boards of directors are there to look after their shareholders' interests, and they add value. And they add value whether that's by cutting fees. Actually, today, we've got Greencoat UK Wind announced that they're going to base their management fee on the lower of either net asset value or market cap. Used to be just based on net asset value. So, they're reducing those costs for their shareholders. They're buying back in shares or tender offers. So they're thinking, what do shareholders want to see us do? How can we deliver value and enhance the NAV for their shareholders? Mergers, but also they are making the ultimate decision. And if there is not demand for those companies, they're being wound up. And that, obviously we have a board director here today clearly boards generally add a lot of value for shareholders.
I would certainly like to think so.
Please.
I think, 30 years ago, I first got involved in the investment companies sector, and Annabel's been nearly as long, and it was very different then. You had a lot of managers represented on the board. You had far less independence, far fewer people listening to shareholders or communicating with them. Now, it's very much a part of the role is to, think, are the fees right? Is the structure right? It's fine if you're out of favour, but you need to have a strategy long term for that fund to be justified, either through the mandate or through performance in future. And if it's not, then you've got to look for solutions, whether that be a merger or a wind up. And I think increasingly boards are willing to do that.
Yeah, if I could follow on from that, I mean, we cover the whole of sector, and I think we've been very encouraged by sort of the amount of responsibility that boards are taking in terms of taking action, improving corporate governance, reducing fees across the board, because it's not just about cost disclosure, it's also about the actual level of cost, which is coming down across the board, partially because of these mergers that are happening in the sector, but also almost every interim or annual results announcement you see will include something to say that the board has gotten cost further down by negotiating with the manager. I would like to say something about sort of these idiosyncratic issues that you flagged up of a number of trusts. I would say this is less than 1% of the total of investment trusts, and it shouldn't sort of tar the other 99%, because I don't think even in the FTSE 250 or in the S&P 500 or whatever, you will have much less than 1% of companies where there might be an idiosyncratic issue. And even for those where their reputation maybe across investment trust investors has been somewhat controversial. If you look at Hypnosis, it's been taken private by Blackstone and just recently securitized their assets for raising 1.5 billion from private markets, who apparently do think that this is not that much of a questionable portfolio, and indeed reportedly the valuation is up since it's gone private. So yes, there are idiosyncratic issues, but I do not think investors would be wise to take them as representative.
I'd also highlight that it's actually a positive that you're seeing the corporate action take place, and also there's been examples where I think boards have put forward proposals which aren't in shareholders' interest, and then they've had to go back on them. So you had that recently with Bellevue Healthcare proposing to change a regular annual redemption that offered shareholders, and shareholders clearly weren't happy, and they've gone back on that proposal. And I think that it's encouraging shareholders are now being much more vocal and forcing change. And if that creates publicity, then that's fine, because ultimately it's just accelerating, I think, survival of the fittest within the sector.
Absolutely. I mean, and it's just to come back on that then, is that really the case then for the active management that an investment trust brings? Because we're at a time where we're seeing an increasing turn towards passive, lots more people just funneling money into ETFs. How do you kind of make that?
Can I make a point there, though?
Sure.
I mean, part of this, and I can see that is happening and is likely to continue. But if you look at performance year to date, although, as Annabel said, 13% for investment trusts, if you were invested in a MSCI global tracker, you'd have 22%, or driven by the US market up about 28%, which is really a handful of tech stocks driving that. Clearly that is unlikely to continue in my view, and really you need a broader market. Investment trusts will always be in more specialist assets, and when they start to outperform and you get a narrowing the discount, you're going to see substantial outperformance by investment trusts, in my view, which will then lead people back into the sector. But we've clearly had an unfavourable market environment, even though absolute returns have been okay this year.
And how do you see that market environment developing then as we look into 2025? Do you want to start with that, Shavar?
Well, on the point of the competition from passives, I mean, this is obviously a genuine factor. But I think that there's a number of things to take into account. Number one, costs are dropping from an investment trust perspective. Number two, you can buy them at a discount at present. Number three, they're much more suitable for illiquid assets. They're able to lever. So there's a number of advantages that investment trusts have over ETFs, including the fact that sort of in a higher for longer environment, theoretically, active investors should be able to outperform passives by selecting the companies who actually are there on merit, and not just because they can finance themselves at a cost of capital of zero. And so theoretically, we should be in an environment in which active stock pickers can outperform, or those that specialize, as Charles noted, in specialist sectors can outperform. So by all means, there are purposes for which ETFs are very suitable, but investment trusts have a role to play, we think.
Sure. Anything to add, Annabel?
Not really. I would just agree. Investment trusts clearly have a role to play. They invest in more specialist assets. So, yeah, obviously the Magnificent Seven, it's been a wonderful run, hasn't it? But it can't continue forever. But having said that, we've got a lot of exposure. Our big global trusts are performing very well because of their exposure to the Magnificent Seven. Obviously, our tech trusts performing really well. But you can't. You've got to have a diversified portfolio. You can't have all your eggs in one basket. You need the range of sectors and assets that we cover.
Sure. I mean, and obviously, investment trusts really are a UK success story. They go back to centuries. They're people, especially in the UK, really, really like them for that reason. I just wanted to get your thoughts on how you see the UK environment for next year, and whether that can be beneficial for investment trusts. We've obviously seen the budget. We've had a lot of kind of change, a lot of turbulence this year. How do you see the UK environment next year? Do you want to start with that, Charles?
Yeah, indeed. I think certainly I'm more positive for next year. I think there's been a lot of headwinds. One of that has been, it's the shift in the interest rate environment. So you saw people, as well as holding cash, there was a lot of money going to gilts, which have a CGT advantage for taxpayers. And really, equities have been out of favour. And I think it's particularly in the UK market, you're seeing, a number of factors, particularly buybacks and mergers and takeovers by private equity and other corporates really starting to drive returns. I'm on the board of Temple Bar, which is benefiting from that as a value investor. And so I think, there are certain factors which, certainly help, but whether with Trump coming in, trying to predict precisely what impact that's going to have on global markets is beyond me, I'm afraid.
I should say that this morning I went to the London Stock Exchange, which was being opened by the Mercantile Investment Trust, which was celebrating its 140th anniversary. And it invests in UK and small caps. And I think, there's a general view, it's been a tough place to invest. They were saying if you'd invested £1,000 30 years ago, you'd now have £22,000. I was feeling quite happy because I am a shareholder, I have to say. But clearly, the UK's been challenging, but we have seen those rate cuts begin to come in. Obviously, the budget been a little bit concerned about the inflationary impact of that. But having said that, it could have been worse. We had some capital gains tax rises, but they could have been higher. I think the news is out there now. The bad news is out there. We're moving towards a solution on the cost disclosure. We're expecting a consultation literally any day on that. And performance has been good. So I think there is a lot to look forward to. Exactly whether Andrew Bailey's right and we're going to have 4 rate cuts next year, I don't know. But all I know is I think there's a lot to be positive about.
Yeah, I would agree with that. I think maybe 2 things to highlight. One, if you look at the UK sort of political spectrum, both sides seem to strongly agree that they are willing to do sort of creative measures in order to improve the situation of UK capital markets. So that should be helpful just in general. Then if you zoom out sort of from a global perspective, UK fund managers have been telling us for the longest that sort of since 2016 roughly, there has been this change in global allocation to the United Kingdom, generally speaking. Now, with all of the political upheaval that you can see going on all across the world, there's certainly a thinkable scenario in which the UK is sort of a beacon of stability where people want to slightly increase their allocation. And if that comes from some large players, that can make a substantial difference.
Sure. Annabel, you said, as you mentioned, we are eagerly awaiting sort of the more consultation on investment trust disclosure, or cost disclosure rather. So just as a kind of final question for you all, what's that for you as we go into 2025, what's the one thing to watch in the investment trust landscape?
Well, I think the cost disclosure issue has to be a thing to watch. We're expecting, as I said, the consultation any day. We're expecting the rules to be in place by end of June next year, and then there will be an implementation period. But we're clearly hoping that we're not going to have these aggregated cost disclosures, which have been so off-putting to wealth managers and fund-of-fund investors. And the solution to the cost disclosure issue in itself might be helpful for the sector. We think it will be helpful for the sector next year. Clearly, there's a lot of macroeconomics involved as well, but that will be very helpful, particularly for the alternative investment trusts.
And Shavar, one thing to watch for you?
That is a very difficult one because I cannot think of a sort of single event that people should tune into sort of outside of the cost disclosure, because it's more of of how do trends develop. Because as we've just been discussing for the last 20 minutes or so, there are sort of many beneficial trends that are tailwinds for the investment trust sector. Whether that's sort of maybe a relaxing monetary policy, whether that's from a corporate governance perspective, whether it's from an M&A perspective, a cost perspective, from a regulatory perspective. There's all kinds of different elements which may be very useful. I don't think there's a particular trigger people should use in order to decide to get in. I think they should do their research, and this seems like a sensible time to do that.
And Charles, anything in particular?
I think that it's really a continuation of what you're seeing in terms of the corporate governance going to lead to further fee cuts, further M&A, further discount controls being introduced. And I think all of that is positive for shareholder returns. When you've got wide discounts, they've stabilised. But I think this is what's going to drive them in. And as that happens, if that combines with NAV uplifts as well and healthy yields, you're going to see shareholders and potential investors starting to notice that actually it is an attractive place to put your money. So I'm very positive, but the timing of that is always hard to predict.
Brilliant. Thank you very much, all. So thanks very much to Annabel, Shavar and Charles for joining us today, and for your insights as well. If you would like to see any further coverage about investment trusts or more from Investment Week's 2025 outlooks, then please check out our website in the link description. Thank you very much for joining us.